This is an urgent warning to NVIDIA shareholders. If you plan on getting more shares, do not buy them now. Do these 3 strategies instead. In fact, I'm gonna talk about a key price level that if we break below, this is gonna look really bad for NVIDIA, but I'm gonna give you my outlook, exactly what I'm doing with my portfolio, which I have a 6-figure position on in NVIDIA, and I'm gonna show you how I'm going to mitigate risks to potentially participate in a huge upside swing. So let's go ahead and jump into it. As you can see, portfolio is currently sitting at 660,000. I plan on turning this into 10 million in the next 7 to 10 years. So if you haven't, make sure to like the video if you get value out of it and subscribe down below to watch the journey and participate along. Also, if you want my free stocks picks or options plays in your inbox, go ahead and hit that first link in the description. That's gonna be my Options Trading University newsletter. If you have any questions throughout the video, you could either comment down below, I'll respond, or you can message me personally on Instagram, it's Ryan Hildreth, and I'll get back to your DM there. If you wanna see my personal life, I post everything there. Now let's go ahead and jump into it. Remember, this is not financial advice. This is just me sharing how I've built wealth utilizing options. Now, NVIDIA. What is going on with NVIDIA? Why has it taken quite a decent pullback since the earnings? The earnings were great. Why is it continuing to go down? And I'm gonna talk about that and where I think it's headed. Now, one thing that I do wanna point out is that when Jensen Huang talked about NVIDIA earnings, he talked about the company, he said that it is the case that demand exceeds supply, and that's expected as we're in the beginning of this generative AI revolution. So basically he was talking about the new chips, which are the Blackwell chips. They can't even supply the companies that are purchasing from them with enough chips because there's so much demand. A lot of different companies are building out their AI models, building out the training models for their AI, and they need NVIDIA chips. So this is actually a very, very good thing. We do want to see NVIDIA getting so much sales that they can't even supply enough chips. This will either A, require them to fix that problem and get more materials to supply those chips, or B, increase the product's price, okay? Which is gonna be better for NVIDIA shareholders like me and you. So this is something we do wanna see. I also wanna talk about briefly, I'm not an expert in chips and AI technology, but just comparing the NVIDIA Blackwell chips, which is the newest chips they're selling to Facebook, Meta, Microsoft, Amazon, Google, compared to the NVIDIA Hopper chip, it sounds like this thing is way better, right? It's 2.5 times faster as far as AI training. Its performance is 25 times faster, and the power efficiency, which is great. Companies are spending billions of dollars on these chips and hundreds of millions on the electricity to actually run the chips. These are up to 25 times lower cost and energy consumption. So basically, the NVIDIA chips are getting smaller, faster, and more energy efficient. So think of it like the iPhone, right? We're always getting the brand new iPhone. If you got, let's just say 10 years ago, which iPhone did you have? I had like an iPhone 3, right? And now I have the iPhone 15. So every single year I'm getting a new iPhone, upgrading. I want the better camera. I want the faster technology. I want more storage and space, right? It's the same with these companies purchasing AI chips. They're gonna continue to purchase the latest and the greatest. And this is a great business model that NVIDIA has with their chips. They're constantly improving the product, requiring basically these companies to upgrade to the newest product. So this is sustainable over a long period of time, especially since we're early to the AI revolution. Now, NVIDIA stock, okay, we're up 174% year to date. Past 5 years, 2,300%, great. I think in 2025, we could pull another 60 to 80% minimum, right? Maybe even 100% or more, depending on growth factors, okay? PE ratio looks extremely low for a company like this, 53. I mean, they were trading back last year at 247 times earnings. So now you're getting basically a 5x discount on the stock. So again, great for investors. and this is something you want to see. Now, if we go to basically the analyst, I don't really listen too much to the analysts, but I do want to see kind of their ratings, kind of where they put price projections and targets. And the lowest target is at 160, okay? And they're trading at 136. So this is a great time to get a discount on the stock. Now let's talk about prices, okay? Price levels, where do I see us going? We just touched the bottom Bollinger Band yesterday and kind of bounced back up to this 135 level. The bottom Bollinger Band is at this support level of 132. If we break lower, we're probably going to go down to this 128 level. And I don't see us going much lower than that. If we do, then we have another issue here. Potentially there is a lot of support at 125, but I don't see us getting that type of pullback on NVIDIA. If we do, I'll show you how to position yourself for that with a specific trade, okay? So I do see us kind of reverting back to this mean price of 140 to 142 very shortly here. But this is how to position yourself to get NVIDIA at a lower price so that you're not buying the top, okay? Now, right now, you're definitely not buying the top. Right now would be a great time to do a covered strangle. So let me explain what that is if you don't know what a covered strangle is. Instead of buying 200 shares outright, you're gonna do something different, okay? Now I have a covered strangle in here. I have many shares, right? 200 shares, 400 shares total. I have 9 cash secured puts. So I'm willing to get basically assigned on $90,000 worth or $100,000 worth of NVIDIA shares. And I currently already have 50, 60,000. So this is great. I'm really all in on this stock, and I believe this is a great time to do a covered strangle or just a cash secured put. So let's talk about it. How would I do the covered strangle? The reason I believe a covered strangle is good right now because the stock is touching the lower Bollinger Band, okay? Great time to purchase shares, but again, we could go a little lower. So how do you position for that? First, you're gonna buy 100 shares, then you're going to sell a cash secured put for the next 100 shares, but you're gonna do that at that price that I talked about, okay? Worst case scenario, we go out to, let's just say December 27th, and if you wanna go a little bit longer to collect more premium, you can go out to January 3rd, 36 days. That'll be a good one, okay? And you could go down to that 125 level we talked about. Worst case scenario, hey, you get assigned at that level. That's a 22 delta. You're getting paid $223. Let's do the math on that. 223 divided by the cash required to purchase 100 shares if you get assigned at 125. That is a 1.7% return, okay? So not bad. You get paid 1.7% return on capital, and potentially you might get assigned on the shares if the stock actually goes that far down, okay? I don't think it's going to, but if you wanna play it safe, you could do the covered strangle where, again, you buy the 100 shares, you sell the 125, you collect some income on the cash secured put, and then you could actually sell a covered call against your shares that you purchased. So you're collecting income on the put and on the covered call. So where would I do the covered call? That's the biggest question. I'm super bullish on the stock, so I would do it probably around the 20 delta. I would go to the 150. I currently have some 155s, which is the 16 delta, okay? Collect a little income there. Depending on how bullish you are, you can either go to the 148, which is like 27 delta, or 155 if you want to go super safe and you think the stock is going to go way up from here. You don't want your shares to get called away. Then you sell, the 155 covered call or maybe the 150 covered call, collect your $200, call it a day, okay? So you collect over $400 in premium and you own 100 shares. So when it goes up, you're gonna participate 1 for 1, right? So that is the best strategy. The safest strategy would be to just sell 2 cash secured puts, layer them in. You could sell one at the 125 strike to be super safe, and then go a little bit more aggressive with the next one. Maybe, you're at 22 delta. For the next one, you could go to the 130 strike, okay? So you collect $223 here, collect, you know, probably $300 here because you're going to get filled somewhere in the middle. So about $300 there. So that's $500 collected in premium. You may get assigned on the 130s, and the 125s, you're probably not going to get assigned. Okay. That's the safest strategy. So those are two strategies. Let's talk about a third strategy. This is for potentially smaller accounts that don't have enough money to purchase 100 shares, or you just don't want to lock up $10,000 or $13,000 in capital to purchase the shares. So what I would do is if you believe in the stock, you could do a LEAPS call option. Okay. This is a long dated call option. We'll go out to December 19th, 2025. Okay. So that's the end of next year, right? You'll go to the 70 delta for 3,000, or you're going to pay probably closer to this price. So $3,400. Okay. You will basically have the right to buy 100 shares at 126, but you'll buy this LEAP option. For every dollar that NVIDIA goes up from here, you're going to make 70 cents on the dollar. Okay. So that's a great way to participate in the shares, right? You're purchasing the call option, which controls 100 shares for $3,400, which is 3 times or 4 times cheaper rather than purchasing the shares outright, right? So your capital requirement is 4 times less than just buying shares. Now, what's the risk? Well, the risk is, you know, in 2 years or a year, right, that NVIDIA is below 126. Maybe it trades at 120 or 124. Now you can either you lose on the trade, you lose out on your $3,000 in a year, which most likely that's not going to happen, but that risk is always there. Or B, you have the right to buy the shares at 126. So you pay additional to buy the shares and you just own the shares at a discount. So that's the worst case scenario, but that's not very likely, especially because we're in a bull market. We're in a lower interest rate environment. Like interest rates are being lowered by the Fed, and I don't see the markets going down from here. So this is my 3 strategies that I would deploy. I've already deployed 2 of those strategies. The LEAPs, I'm not really a big fan of on this particular stock. I'd rather just own the shares, but you can do it how you want. And remember, if you like this video, make sure to thumbs up, give it a thumbs up, and I'll see you in the next one. Take care.